Hey folks, we are within 30 hours of that amazing 39% off coupon code link down below expiring tomorrow, Cinco de Mayo. So check out that program, all of the programs which you can bundle up, linked down below. Look forward to having you. And folks, here we go. Okay, I have to say, I really wonder if the Suits and the Weenie Babies caught wind of this Janet Yellen interview before the rest of us in the public caught wind of it, okay? Because the market is selling off, and about an hour and a half after the market started selling off, actually probably 2 hours after the market started selling off, all of a sudden, we hear about all these comments that Secretary Yellen had about rates and some other commentary, which we're going to break down here. And it's really, really interesting that the market somehow sells off a couple hours before those comments come out. Oh, but the market's efficient and the game's not rigged at all. Jeez, folks, it's a mess. Let's talk about what's going on. Okay, first of all, yesterday, if you've been watching the market open and close live streams, I mentioned while the S&P was green, I'm like, folks, I'm waiting for a big sell-off, a correction in the S&P 500 to start buying the dip on my techs. That's because it's based in this belief that I believe right now we've been seeing a sell-off in tech and high PE. We know that. We've seen that sell-off. We have also seen a rotation continue into cyclicals, recovery stocks, industrials, and this is why you have tech selling off, especially after great earnings, while at the same time the S&P has been on an uptrend because of that rotation into these other sectors. And so my belief is, for us to really hit a bottom in this market, like peak fear, peak sell-off mode, we really needed, and I said this yesterday, we need the S&P 500 to sell off, and I mean like sell off, like 10, 20, 25% correction. Pull this S&P back down 3,200, 3,400, 3,500, 3,700, certainly down to these levels, right? Pull it down. And then when the broad market consolidates and correlates, like when everything is going down together, potentially that's when we get the reversion out of shorts, puts, and selling. See, when you have some sectors selling down, high PE and tech, and others going up, that just means at some point the other sectors are going to get really stretchy valuations because even though it may not seem like it, recovery stocks, to make this simple, think about like Macy's. Macy's, even though it may sound crazy, it is rubber band attached to Tesla. Okay, that sounds insane. Like they have nothing to do with each other, right? Yes, they do. They are opportunity cost choices. The more you invest in Macy's, is the less you invest in Tesla. And when Macy's gets to a ridiculous premium and Tesla sells off, you start looking going, maybe I should sell some Macy's and buy some Tesla. Okay, this is why they're rubber banded together. So here's what happens. And this is why I made this conclusion yesterday. You can't have Macy's go to the moon and Tesla fall without at some point Macy's rubber banding down. And I think that rubber banding down could lead the entire market to slingshot a little lower. Then we could potentially see, okay, now we're getting to that level again where we get that minor correction. I don't think it's going to be massive. I don't think it's going to be correction level of March 2020, but we've kind of already been seeing this obviously start in tech and these high multiples. I don't think they have far to go. Another 10%, totally reasonable, could happen. The others, the industrials, the recoveries, they could see the 20, 25%, 30% sell-off. Now you get this pull down. Now you see everything at a lower level, ideally, and we can't time this. This is difficult, right? So this is why it's like, oh, okay, like you want to kind of nibble into some of these dips, never squander a good red day. But anyway, you get to these potential lows that we might see. No guarantees that we will, but this is just a belief that I have. What happens then? Well, at some point, prices get to levels where the people who are winning, printing tendies with shorts, puts, and selling, they come back in. And as soon as the shorts cover, and the puts sell, and close, get rid of their puts, and the people who are selling buy in again, especially the big institutions and the hedgies, that's when we see that turn back up. Now, I think that turn back up aligns with when we see the inflection point in inflation data. I'm not going to relitigate this because we've talked about this many times on the channel before. That I believe we get the inflection point in inflation data. We're going to go through crap, bad for the next couple months. But sometime between now and the September, October period, we're going to see that ramp. We're going to see that bottom and that ramp again. And this is when we see that rebalancing again of tech, high multiple, and everything move on to the upside. Cathie Wood will be a hero again instead of an ARK fund that you just sell and dump because nobody cares about ARK when it's down, right? Classic. I mean, the outflows at ARK have been pretty substantial. I mean, ARK has not been gaining money for like the past month. It's been gaining money but losing money, and it's been averaging out to zero for about the last month. Anyway, so what did Yellen say, and what am I kind of thinking here? So first of all, I want to make a quick clarification. Remember when in February, end of February, beginning of March, you had a lot of weenie babies start selling, buying puts and shorting? Okay, they're actually doing well right now, in fairness. Not in all cases. Nothing, I mean, there are a lot of stocks that have not hit the bottoms that we've seen in March, but in some cases, those are actually doing very well right now. Credit to them short term, okay? Credit to them short term, they win. Fine. Unfortunately, that actually reiterates shorting. That reiterates buying puts, and that reiterates selling. But at some point, that cycle stops because prices get to a point where they're just juicy again, and you gotta buy them. So at some point, that cycle stops. Now, what did Janet Yellen just say? And how does this enter this whole mix of the selling that we're seeing today? Well, here's what Janet Yellen said today. So Janet Yellen was, and the context is very important here, okay? This is going to get misquoted all day on YouTube today, so and probably media, so be aware of this, okay? Janet Yellen was talking in context of Joe Biden's $4 trillion stimulus plan. She believes that Joe Biden's plan could cause a very modest increase in interest rates, and that there's this reallocation happening in the market right now, but that Joe Biden's plan are investments that our economy needs right now to be, quote, competitive and productive. She says that with these investments, our economy should grow faster because of these investments. And she believes that we saw what happened after the Trump tax cuts, and in her opinion, we didn't see massive boosts to investment. And therefore, higher taxes on high-income individuals, not a big deal. Give the middle-class tax cuts, that's better for growth. Now, there are a lot of arguments, especially coming from wealthier folks, that is Fugazi nonsense. That the more you tax, the more you hurt innovation, the more you hurt the funding of entrepreneurs, the more you hurt the funding of venture capital. The more you hurt the funding and investment in real estate, then the more, especially with this 1031 rule, you cater investors' mindsets towards investing in single-family real estate instead of big multifamily, which just makes it harder to buy a frickin' house, which is already impossible these days, okay? It just worsens the housing crisis. So we got some big issues. But here was the bombshell. So at this event that was recorded yesterday and the details released on now, Janet Yellen goes on to say, quote, "It may be that interest rates will have to rise a little bit to make sure the economy doesn't overheat," end quote, following Joe Biden's $4 trillion stimulus plan. So Janet Yellen is planting the seed here, contradicting Mr. J. Powell, planting the seed that, we might have to raise rates soon to make sure things don't overheat because, we're already seeing some froth in the market, which J. Powell did say there's some froth in the market. And you did already see the Dallas Fed president kind of go, we should start tapering sooner rather than later because things are getting ridiculous out here. It's not good when you start seeing a lack of consistency amongst the Fed and in the Treasury Department. Different departments, obviously, different. One's supposed to be independent of the government, one is part of the government, whatever. But it's not good when you see that lack of consistency because all it does is reiterate what the shorts and the hedgies are saying, which is, we think Jerome's going to have to raise rates sooner than people expect. Janet Yellen's just reiterating that, leading to a sell-off today. Thanks, Janet Yellen, and thank you to whomever leaked it to all the hedgies before us normal folk heard about it. Y'all suck. This is why people say the markets are rigged, but whatever. We know the weenie baby game. We still have some diamonds left on our hands. Some have evaporated in the dip buying, but that's okay. They'll grow back eventually, right? Jimmy Neutron's microwave. Crop turns into diamonds at some point. Anyway, she goes on to say that the greatest threat to our economic recovery and long-term economic prospects is not a marginally higher tax rate for large corporations or the top 1%, but it's a lack of support for America's workers and families. And she says that we have a We've gone way too long allowing long-term problems to fester, including the fact that our taxation system doesn't audit enough people, leading to the potential of $7 trillion in uncollected taxes in over a decade. This is part of Biden's big movement to get a lot more audits going to make sure they collect more and more taxes. Janet Yellen says marginal tax rates are much less powerful in influencing growth than many thought. Little evidence of a burst of investment after the Trump tax cuts. Talked about this. Okay, she did say she does expect interest rates to remain low, or us to remain in the low interest rate environment, quote, for some time, but need to make sure deficits remain manageable. Okay, well, maintaining manageable deficits means not spending as much. So she's kind of also beating up on Biden here, kind of like pulling in the reins a little bit, going, Biden, $4 trillion, okay, hey, Janet's printing now, okay? Well, she's working with J. Powell on the printer, and Janet's like, well, that printer's running a little hot. Biden, pull it back a little, okay? Just a little bit, okay? It's ridiculous. This market's madness. So in case you're wondering why the market's all poopy-doopy today, thank Janet Yellen and thank the people who leaked all this crap before. And thank more Fugazi around, obviously, the potential for inflation. Although I will say we had softer manufacturing data come out this morning, which has led to the 10-year to rotate to the downside a little bit. Anytime we see less overheating in actual statistics that come out, which Friday's unemployment number data is going to be huge. I will be live streaming that at 5:30 a.m. Pacific time. Not looking forward to it, but I will be doing it because we have to. But anyway, we are seeing this rotation down in the 10-year, which tends to not bode well for Bitcoin prices. Ethereum and Doge not correlated. But although we did have a little bit of a peak here after Janet Yellen's commentary was released, so you did see this fall throughout the day here as we got weaker than expected data in some cases. But we did see a little bit of a spike here after Janet Yellen's commentary, so you are seeing this. Remember, the 10-year Treasury yield chart is your graph of human emotion relating to what people's inflation expectations are, okay? This is your inflation expectation chart, basically. Bitcoin tends to trade with this chart. In fact, here, we'll plop it on right now. It's not perfect, but it's pretty good. Hold on, let's edit the chart and let's make it, let's normalize this to a factor of 100. It gets a little easier to look at. And then you do year to date here. Boom, look at that. You just tend to see the ups and the downs kind of moving together. You had very good correlation at the start of the year. Treasuries run, Bitcoin runs. Treasuries run, Bitcoin runs. Treasuries fall, minus, you got to take out the Coinbase pump here. If you take out the Coinbase pump, you really see that sort of decline with the treasuries here. And then you're seeing that same sort of bumpiness over here as we're trying to decide which way treasuries are going. So you do have that it's a little loose, but you do see a lot of that tracking happening here. So anyway, there you go. If you find any of this information helpful, check out those amazing courses linked down below for perspective on building your wealth. Thank you so very much for being here. Use that coupon code before it expires tomorrow. And folks, we'll see you in the next video.